On August 21, 2026, global petrochemical trade routes are pulling in different directions. Prices that typically move in sync are now starting to separate. This map tracks the immediate shift. Asia is seeing a sharp upward trend in costs, while prices across the US and Europe remain flat or are actively softening. The widening statistical gap between these regions creates a direct operational risk for third-quarter margins. This disparity forces a choice. Do you lock in regional contracts now to hedge against rising Asian costs, or wait to see if the softening US market offers a better entry point? To find the most stable supply chain, we have to evaluate these regions side by side and compare the specific trade-offs of each market. In this environment, your procurement geography determines your level of exposure to margin risk. We start in Northeast and Southeast Asia, where the upward pressure on pricing is most acute. Our comparison matrix isolates the regional move. Looking at the Asia column, ethylene sourced on a cost and freight basis has surged by $40 per metric ton. Operationally, buyers in this region are absorbing that premium right at the start of the supply chain. It presents a difficult trade-off. Paying this increase is the only way to secure necessary volume in a market that is rapidly tightening. If you wait for a correction and the upward trend continues, your raw material costs will only climb higher by the time you're forced to buy. For manufacturers in the region, this creates a tangible squeeze, putting their margins at a disadvantage compared to Western competitors. When supply tightens this quickly, hesitating to buy often costs more than the current premium. The pricing environment in the West provides a complete contrast, showing almost no movement at all. Returning to the matrix, Europe's ethylene column shows free delivered contracts holding steady at €880, registering zero change. The US Gulf Coast shows the same pattern, with styrene holding flat at 61 cents per pound. This stagnation simplifies the forecasting process for regional managers. It allows for stable planning through the end of the quarter without the risk of sudden price shocks to the budget. The downside is that a flat market makes it very difficult to find opportunistic spot market discounts. While these Western markets are currently safe for budget planning, they offer little room for aggressive margin expansion. The one exception to this trend sits on the US Gulf Coast, which currently hosts the only major downward move in the August data. Updating the matrix, propylene in the US has dropped to 42.05 cents per pound. This creates an opening for buyers to acquire material well below the current global average. However, capturing those savings involves a logistical trade-off. You need either localized US processing or the ability to manage the shipping costs of moving volume across the Pacific. Back in Asia, we need to look at secondary feedstocks within the polyester chain. Prices are beginning to creep up here as well. PTA in China is up $5 to $9.20, and MEG is up $10 to $7.35. Buying PTA and MEG now serves as a defensive hedge, securing these feeds before they potentially follow the sharper upward path of ethylene. Looking at this data, the August market aggressively punishes indecision in the East while rewarding patience in the West. We can map these moves by plotting market volatility against acquisition cost. The US markets currently sit in the low volatility, lower cost quadrant. For the global arbitrage trader, the widening price gap identifies a specific pathway. If freight logistics are optimized, the US Gulf Coast is your primary target for moving volume. For Asian regional manufacturers, the position is more difficult. You should lock in near-term contracts now. Waiting for prices to cool is a high-risk strategy against the current upward momentum. For European and US regional buyers, the focus should be on consistency. Maintain your steady-state operations. With primary feeds showing no change, you will find more value in improving downstream efficiency than in chasing spot market deals. Because volatility in one region can eventually impact another, you need to track these shifts daily. The AI-powered Polymer Czar Whatapp chatbot provides real-time feedstock updates and predictions directly to your phone. In a market where regions are moving in different directions, continuous data intelligence is the only way to protect your margins.